Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard. Welcome to our humble show. This is take 48.
We had some equipment issues we were going through, practice and everything. Oh, yeah. Well, that last equipment lasted 9 years, though, before it had to go out.
Before we lost the channel.
Oh, no.
It had to be my channel.
I know. I was really happy. Today I was at the gym, and I weighed myself. First time in about 6 months. I was about 15 pounds lighter. Thank you.
I know, and for 5'5", you're right in the zone, right?
I was like going, oh, I felt really good till I got home, and someone, I won't mention who, but said, yeah, your legs and your lower level's been looking a little skinny and stuff. That's probably where the weight went. I'm like, really? Thank you very much. I was like, what do you mean? This skinny stomach wasn't it? She's like, no. That's just the way it is. Never
that
can
was
get
your
a compliment.
Valentine's Day gift.
That was.
It's so important, and they always tell us, oh, don't get me flowers. Like, whatever you do, don't get me flowers. Of course, all the guys out there, we can't listen to them when they say that. So we go out and we do what we think is thoughtful and nice and really put some thought in it, right? Unless you're in a hurry. I understand those times too, but you try to put some thought in. You go out. What happens when you go out and you get that gift and you bring it home, Victor?
They return it. Never mind.
It gets what they really want. That's exactly right. No matter how much thought you put in, and no matter what you get, with the exception of maybe jewelry.
No, I bought a whole bunch of stuff. Like I went down to like Lululemon, whatever that yoga place, and I went to this jewelry place all over town. She returned every bit of it.
I've got my wife a full day at the spa. I thought would be nice, and you walk in, and you smell the scents, and they can get a massage, and all day, right? Returned it. What?
No.
Just can't win.
No. My wife has told me, no more jewelry, no more purses. I'm like, I thought isn't that what you guys like?
Now, if you've ever gone out and bought your wife a purse, all you guys listening out there, right? We wouldn't even know what purse to get, right? One year it's this, next year it's that.
Well, I just look at the ones that are ridiculously overpriced crap. And that's usually where I start the search.
Doesn't it have to match their ensemble, and that whole thing's got to be choreographed?
I don't know how that works. My wallet matches every single pair of pants I've got. I have no idea.
Mine too. That's right.
I don't know.
And now, the more worn out it is, the more class it's got.
My phone cover looks the same. I don't care what outfit I'm wearing. Doesn't matter.
That's right.
I'll wear white anytime I want to. I don't care.
That's that Mars and Venus thing.
Oh, I know. That's true. Well, the stock market. The stock market is still volatile as crap.
Yes, it is.
I had a client come in, and they said, the reason why we went with you years ago. I was like, well, it must be, the knowledge I have of the market, my experience.
That's right.
Never had a complaint in 30 years. It's got to be one of those things.
Yeah,
right?
Wonderful presentation.
I said, no, we heard you say crap load on the radio. And we thought it was hilarious.
We need to use that a little bit more.
And I go, that's not real. He goes, oh, yeah, you don't talk like normal people. I go, okay. I go, I do talk like normal people, not like, but the opposite of Ivy League person or something, right?
Yeah, and the truth is, Victor and I get calls all the time, especially now. For the longest time, we didn't when the market was going straight up. And everyone wants to know, what's the market going to do? Is it found its low? It got right down the S&P got within 5 or 10 points of the 200-day moving average, which was a real big baseline, and it didn't break that, and some people seem to think that it's found a low, perhaps not the low, but a low. But really, the economy is doing very well. The earnings are coming back. They're better than they were. Employment is good. Wages are coming along. The effect of the new tax laws and things really hasn't come to fruition yet. It hasn't manifested, I guess is the word I'm using. So all of that's good. Now, does that guarantee that the market's going to go straight up from here on out? No, it doesn't. But it's good. All that is really good stuff. On the other side, which is good, right? Normality, you've got left in a white wing like we do in politics. You've got bonds competing now because they're going to raise rates on that. You've got the unwinding of the easing. Quantitative easing. Couldn't think of the first word. The quantitative easing. A lot of bonds coming on the market. So you've got some issues there. We've got some debt. Does that mean the market's going to go down, then you should get all your money and come out of the market? No. But what we would like and what we try to do, we'd like to see you do, and what we do for our clients is just get a nice balance. You know, you've got several buckets. You've got the liquidity. You've got your income. Take care of your income so you don't have to worry about that. And that removes the stress on the stuff that you have in the market. You won't be going crazy every time it goes up and down.
That's amazing to me. I remember we started doing making the emphasis on retirement income. The reason we did that is baby boomers are retiring. That's the largest group of people, right? And it's the first generation that was without pensions.
Right.
So they're living longer without pensions. So basically all of the retirement savings came up to the individual, which is a heck of a lot harder to do than, say. So we knew the result of that. And we started using index annuities because you can get them for 0 to 1% fee.
Back in 95 we started.
And my cousin, he works at Fidelity, but I've got all the big brokerage firms. Oh, no, you should not do those. Those are terrible, blah, blah, blah.
Right.
Now every one of them does them. I had a customer who just went to a Fidelity seminar the other day, and he goes, they're saying the same thing you've been saying for 20 years. And I go, and Merrill Lynch. And every one of them does the same thing now because they recognize at first they just didn't offer them. And so that's the one thing. It's hard when you hear competing advice from different people. If they don't offer the product, they're going to bash it because otherwise you're going to go somewhere else, right? So now the world has kind of changed. It's kind of open architecture. That's why all our manager accounts are at Fidelity. You can have your stuff anywhere you want, but have the advisor you want too.
And if I can interject before I lose my train of thought, which seems to happen at 60 or close, the real important thing. So what's the difference now? A lot of the large wirehouses, they're new guys. They come there, they're cutting their teeth. Even the seasoned guys that have experience, they're putting a mind vice, if you will, to use as a metaphor, for whatever that company or whatever that wirehouse is and whatever their approved products are. We're a boutique firm, for lack of a better term, boutique firm, because we can go out there and shop. We do annuity rate watch. We use all sorts of tools, and at any given point, whatever it is you're trying to accomplish, some of these do real good for accumulation of wealth. Some of them do better than others for lifetime income and spousal incomes, inherited IRAs. I mean, there's many different ways that you can use these tools, and you want to use the very best. If you go to a Chevy dealership, they're not going to tell you need to buy a Ford because they don't care. Although they're both cars, right? But they don't sell Fords, they sell Chevy. So same thing. One of the advantages here is we can go out and do our homework and search the entire universe of income-producing investments and find you the very best.
And it doesn't cost you more, and most times it costs you less, which is nice. You can do it's like a one-stop shop. Now, I know there's stuff like that in the car business where like a leasing company may go out, but they're not, like I said, they're not experts in every single make and model like we are. We've been doing this 30 years each. Each one of us has never had a complaint in over 30 years.
Oh, don't say that. Knock on wood. Don't say that. He didn't mean it.
Well, let me tell you what I started my career, when I started on the radio and things like that, and started doing seminars decades ago, is I exposed things about the market, and I used to do mutual fund fees, hidden fees in mutual funds. I don't mind a mutual fund. I just don't want to pay 3 times the fee for the exact same stocks because it's packaged differently.
There's a better way now.
That's right. So there's better ways to do it, but achieve the same thing. And so that's how we do the same thing we told people in this radio show, for the average person, when I mean average, I mean just about anybody, you should stay away from private investments. For decades, it's been oil and gas. Things were private. Another thing is you've got, but the last, say, 10 years, there'll be more private REITs, real estate investment trusts.
They're tempting because of the interest rates they offer.
They're saying, there's own prime New York real estate, 10 to 15%, 15% a year, We've got 10 billion properties, and we've got about 1,000 years experience between the three of us. Whatever.
If your IRA is losing money, get out of your IRA.
We can beat the pants off IRAs, whatever.
Yeah.
But there's so many things. There's an example just came out this week of why you need to stay away from private investments. There's 2 Dallas promoters. They were ordered by the state of Texas Security Board
Ruh-roh.
To stop everything. Basically, stop marketing.
Cease and desist.
That's right. What they did was they were raising $4.4 million for a reentry well in Kansas. Now, $4.4 million. Now, here's how it broke down. $1 million went as a finder's fee, them to locate this particular well. Problem is they own the company to the finder's fee. So out of $4.4 million, $1 million went to their other company they own.
That's 25%, yes?
That's right.
$1 million and $4 million?
All they could find is what they actually spent on the Kansas oil and gas project was $750,000.
Wow.
So before we start this whole project, they've got about $3.5 million out of $4 million in profit already.
Now, I'm not familiar with Victor's example, but I am familiar with how these work. Now, you realize, so out of $4 million, $700,000, which is less, call it 20% or less went into the well. Well, you don't get 100% of the well. They've got what's called working interest and net revenue interest. So they skim some off the top, and the working interest is what you pay is nowhere near 100%. So you can have 50% paying for 100% of the bills.
Oh, absolutely.
Were you going to go there next?
I'm going to charge you a management fee. You have to manage this ongoing thing.
Right.
So not only get the working interest and managing interest, all that. So you're going to pay $4.4 million for something we paid $750,000 for.
That's right.
And we're going to own half of it. You're going to own the other half. Now, because my half gets to make all the decisions, yours doesn't. And on top of that, you're going to pay us $250,000 a year to keep ongoing management of it.
That's right.
And so they'll
you get 100% of that bill.
That's right. And so the reason why. Now, is that illegal? It's illegal because of the way they were promoting it. If they'd have fully disclosed all that, they wouldn't have sold as much, but it wouldn't have been illegal. Because private investments, there's no rules.
That's right.
Let's say I was an embezzler. Let's say I was the biggest embezzler, identity, online thief, whatever. I got caught and went to jail for 10 years. The day I get out, I can be the #1 private REIT salesman in the world. I can be the #1 private oil and gas salesman in the world. There are no rules.
That's right.
With us, we've got 4 government agencies that monitor everything I do, and you just get anything at all, you lose your license.
And look at Madoff and all those. It was president of the exchange. Even with everything we've got to go through, you still run into people that aren't morally correct and they do wrong things. Can you imagine if you had no guardrails in place at all?
They don't have to disclose this stuff either. No. They'll always say if you're a accredited investor. If you're a accredited investor, they can basically legally screw your eyes out and get away with it. This people just got caught. 99% don't. And like right now, if you want to relate this to private real estate investments, a lot of times it can go along for 20 years and actually work because they didn't gouge you too bad, right?
Right.
But what happens is if they ever stop raising money, that's the definition of a Ponzi scheme. If they ever stop raising money, they manage those properties that they've been paying you these royalties on or whatever, right? What are they going to do if they keep raising money, which is half or 2/3 of their income every year?
Right.
We need to raise the management fee on all those partnerships we put out. They could just double, triple, quadruple management fee, and they could double it every single year till the money's gone.
And it's in
There's
prospectus.
no law against that.
That's right.
That's right, because they control it completely. So private offerings are terrible. Now, if you're talking about public real estate investment trust, that's a whole different world. You may have, when you're going IPO with a public, you can only have maybe 15% profit in the whole deal. And that covers all the marketing, printing costs, everything. But when you go into the private world, and when they start talking about accredited investors, sometimes they don't say it. It's buried in this forms they're having you sign that you just signed you're accredited if you are not. And they get that through that way, and that's the problem with these things. The market is risky enough. We've seen that, especially the last few weeks, right?
Yep.
The market is risky enough without worrying about somebody stealing the money. But, you know, I've had people arguing with me like, you don't understand. This real estate is, this guy is so-and-so. I had one guy
Life
tell me
settlements.
the guy drove up, he flew in and had a Lamborghini. I go, what the hell does that have to do with anything? I'm thinking he's more of a crook now.
Yeah. Oh, yeah.
No, this impressed that person.
I had another one tell me, he deals with all the congressmen and senators, or several, not all.
right.
He deals with several, and I'm thinking, holy cow, run.
It's probably, what do you think, Guy? What do you think the percentage of private deals that have gone bad that you've known of in your lifetime?
Yeah. Gosh, I don't know. It's in the high in 90s. Even in private deals, even if they are doing everything right, it's difficult for you, the investor, to make out.
That's right. When they control everything, and there's no regulation that they cannot.
There's a reason they're private.
That's right. And it costs money to go public, right?
That's right.
Now, sometimes, and here's another scam. I'll say it's a scam because what happens about 1% of the time. The private offerings, they're going to go public. We're going to raise this money and go public. Problem is, there's so much fat in those things, they can't go public.
No.
Because remember, there's so many, but they always tell you, no, we're about 3 months away from going public. You better get liquidity here in a minute.
And they use fancy terms. I've even heard people say that they use big fancy terms. If you confuse a potential investor, makes you look smart, which is not true. I forget. Right. You know who I'm talking about?
Oh, yeah.
A particular individual that was an acquaintance, but you just got to watch it. They don't tell you everything. They use fancy
really
words
important.
like exit strategies and stuff.
We have 10 exit strategies, blah, blah, blah. We think Warren Buffett's going to buy out this piece because this is right up his alley. This is the type of things he normally does. That's a bunch of BS. Don't listen. Like I said, remember, there's sales involved in every facet of business just about. But at least you've got strict controls on what you can say and what you can't say when you're registered.
And repercussions.
That's right. And we're legal fiduciaries.
That's right.
We have to put your interests ahead of ours. In their credo, they have to put their interests ahead of yours.
People in our industry, like we said, can make mistakes and go rogue, but there's a penalty if they do.
Oh, yeah.
In the other industry, all they got to do is tell you there's conflicts of interest here, and we're going to manage this there. And
I had somebody, the friend of mine, that was going to go work for one of these firms. I looked it up, and they said, you don't understand, Victor. They've got a beautiful office over in Crescent Court or whatever. And, yeah, they're younger, but the guy was on The Bachelor and this and that. I'm like, what? I looked it up. I said, here's the quick deal. Look them up. Look how long their company's been in business. Don't say they've been in business. Look at that specific company. What they'll find is this one particular firm had changed names 8 times in 3 years.
Yep.
And then 7 years ago, they were like a hairdresser or something. I'm like, what? But they're driving Lamborghinis now and everything.
Oh, yeah.
I go, so you got to be really careful. Anything private, stay away from it. I don't care what anybody says. I've offended somebody. A very good friend of mine was dating a new person. And I was going off about private oil and gas. They happen to be a private oil and gas salesman. So
we're at the Star now, the capital part of the Dillon Gage and McClure Capital. But before, when we were at Dillon Gage and had the floor there at the Colonnade, one of the IT gals, who's no longer there, came up to me and was asking me about, she said, my husband and I, and they're getting close to retirement, early 60s, are thinking of putting $100,000 into a REIT. Rate of return, 7.5%, 8%, big number. And I shared with them what we're sharing with you now. They have to go public for you to get your money out. Yes, you'll get usually that 7.5% for a period. And I went through all... I should have asked questions first. I went through all the reasons not to do them and be careful. And your $100,000, 7.5 sure is great, but it'd really be better somewhere else. You'll get a little bit less, but you'll have access to your money. You won't have the problems. It won't be private. And after I went through this for about 15 or 20 minutes, she told me it was her son that was selling it. Has a new job with this company and it was a private deal. Right. And what do you say?
The oldest person at this company that my friend it was 35, by the way. The oldest person. That's the oldest. You don't understand. They've been in business a long time. I go, do you know they were a hairdresser 7 years ago? They couldn't have been in business that long. I'm just saying. And by the way, the company's changed names 5, 6 times. I mean, come on.
Yeah, there's a reason.
All right. Let's do a little bit of Economics 101.
All right.
I've had a few calls lately. We talk about, interest rates, how that affects things, how the dollar affects things. And people don't, they said, I'd like a little more clarification. I don't really understand why an increasing dollar would help or hurt. And I go, it sounds like increasing dollar would help us, right? Okay, so let's kind of do this. Let's say I'm an exporter. I sell a bunch of stuff over in Europe against the euro, right? Okay, what if the dollar gets stronger?
They have to pay more of their money to buy
right.
our stuff.
That's exactly right. So, and that can happen, right? So I'm going to make more money. Well, not exactly. Because you can't raise prices fast enough to offset the difference. You know?
Right.
When you're trying to offset the difference, like in other words, I'm selling jeans over in France or whatever, I'm not going to charge 10 times more for the jeans just because the dollar went up, right?
That's right.
So I lose money when the dollar goes up, typically. If it happened over real gradually over a long time, you can raise the price enough, but you get your price too far, they're not going to buy the jeans there anymore or whatever, the cars or whatever. So if you're an exporter, you don't want a strong dollar, right? If you're an importer, stronger dollar would help you, just the opposite, right? Because your dollars will buy more euros now, and they're only asking this many euros.
That's great.
Right? Same thing with the Japanese yen, the Chinese yuan, any of them.
And that was kind of the reason behind the euros. You had all these little countries and all their currencies, and they even at one point they were suggesting an Amero, right, for the Americas, plural, which I even heard they had machines and palleted money, but apparently that was propaganda. But, you know, they tried to control it. If it was all one currency, then you wouldn't have the discrepancy.
Now think about it the opposite. Let's say you're China, and you're selling stuff to the U.S. The U.S. dollar rises. Well, it actually buys more yuan, right? So it's actually okay. So I had somebody tell me this one time, well, those other countries hate when our dollar goes up. I go, not really. If they're a big exporting company, they're okay with it, right?
Yeah, they are. And these companies that do large trading, like people that are in the gold and silver business, like Bill Engage does a lot of physicals, they hedge their stuff. And you know, that's what we used to do before the quantitative easing came in and the Fed stepped in and tried to control everything. If you would hedge these different things instead of the government coming in and buying down rates.
It's basically buying an insurance policy on currency fluctuation.
Right.
That's what a hedge. That's what the commodity markets were designed for. People don't realize the commodity markets are hundreds of times bigger than the stock market. Because every country does it. Banks do it. Everything.
That's how they make their money.
That's right. So even though we just said this, large people exporting, import, they probably got it hedged, so the dollar doesn't affect them as most. It affects more of the smaller ones that can't afford to hedge or don't hedge. Like you'll see, remember American Airlines, all the airlines almost went bust a few years ago because they weren't hedging their fuel cost. Southwest Airlines was hedging their fuel cost, and they did okay. But so when the things are going great, they make more money because their cost of hedge is gone. But when things go bad, they lose a fortune.
Think, if you want to individualize it, and maybe it'd make a little bit more sense. Think if you're going to go on vacation to Europe and the dollar is weak. Now, for every dollar, you would only get
so many euros.
So yeah, you'd have to euro would be like $1.60 in when you converted your money. So you'd have to give more of your dollars to get these euros. Yep. And if the dollar was strong, then maybe it was 1-to-1 with the euro. Yep. So if you were taking a trip, you'd want the dollar to be strong because you would buy more when you were over there.
That's just see when the dollar is weak, how many tourists you get.
Right.
They all come because it's cheap.
Yep.
Just like the last 2 times I went to Europe, first time it was around $1.60 for a euro. Next time it was like $1.10 or something.
People will
way
plan
cheaper
trips around that if they can.
Oh, absolutely.
I mean, the real international jet setters.
So that's what a rising or weakening dollar does to the economy. Don't get me wrong. Some companies only sell domestically, so a rising dollar's fine, right?
Yep.
But if they're selling a lot of export, which I'll give you an example, Coca-Cola makes 2/3 of their profits outside of the United States, and so does companies like a large portion like McDonald's, things like that. So it's a mixed bag. In other words, dollar increasing is a mixed bag to an American company or to a foreign company, depending on the circumstance. If they're more exporters, importers, whatever.
And the counterintuitive part about that, right, is you have dollars, you get paid in dollars, you think dollar strong, dollar good.
Right.
It depends, right?
Right. And the other thing is this. They said, why would inflation, a client asked me, okay, you say the inflation cools off a overheated economy. I don't understand that. Why would it cool off anything? All right. Well, here's an example. We are a consumer-based society, right? What is it? 75% of our entire economy is what we purchase. When the interest rates are low, what do people do more?
Borrow.
They borrow more, right? So that means they buy more houses.
Yep.
Because the payment is half of what it was with this other interest rate, right?
Or cars.
That's right. Or cars.
Or boats.
Or boats. Everything.
Right.
Because we are not only a consumer-led society, we're also a debt society. We do it on credit, right?
Yes, we are.
All right. So let's say that they start raising interest rates. Everybody's, why are they raising interest? I don't understand. Isn't that shooting them in the foot? It is shooting themselves in the foot to some degree with like the national debt. But it's the only way to slow it down. Because what you'll find is when the economy's good, low interest rate, people are buying stuff, they feel good. You'll also see companies like right now start to raise your rates, raise your pay.
That's right, bonuses.
So they're raising pay, and it's going up more. Now they're buying more because they have more discretionary income. They're buying more and buying more. Well, it's causing the price of these things to go up and up and up because in a supply and demand capitalistic world,
fundamentals.
That's right. The more demand, the bigger the price, and that's what my son asked me. Why do these baseball players make $20 million a year? I go, it's all supply and demand.
That's right.
How many people can hit that ball that's good or catch that ball or whatever? There's so few of them in this entire planet.
That's right.
That the demand is high, but the supply is low.
And in fairness, I know they get crazy money, but their I want to say their life expectancy, their career expectancy, coin a new term, is very short.
Oh yeah. Now think about this: if you're the government and you're raising interest rates, right? What are you doing there? Okay, you're raising interest rates. It's going to cost more to buy a car, more to buy a house. Would that slow down buying homes and cars? Which would in turn slow down the increasing prices of each one because the demand has gone down in each one, right?
Absolutely.
And so what you're doing is, as you're raising interest rates, now, do I think it's going to go back to 1980? No. It's not going back to 15% CDs. I'm sorry if you've been waiting for that for a while. It won't happen. But you can see something fluctuate 3 or 4% up from here.
But it's like everything, right? There's not an absolute, is it great, is it bad? It depends, right? If you're retired and you're not working anymore and your house is paid for,
you're not consuming as much.
You're not getting new cars all the time.
Your CD rates are terrible.
Your rates are terrible. You want to get 6 or 7% because that's more income for you. But when you get that, the groceries cost more.
Right.
So it's a very fluid situation.
There's two ways to think about it. A lot of people love that. I hear it, gosh, I've been doing this 30 years. I hear it at least once a month. Oh, I remember when I got a 12% CD.
I wish those days were back again.
Right.
Well, you might not.
Yeah, maybe not.
Maybe not.
Because think about it. At that time, when you had a 15% CD, your groceries and everything else was going up 20% a year. It was crazy numbers.
Yep.
Okay, so it works just the opposite. This is our economics 101 session. So what happens is when they start lowering interest rates, remember the economy crashed in 2008, right? They said, lowered everything down. I think the Fed funds rate was 4 or 5%. Lowered it down to 0.
Yeah, how many times in a row did they lower it? 17 or something?
17 in a row, I believe.
Crazy.
So think about that. They lowered it so much to do what? To spur the economy back. Because I'm not buying a house. This dang thing real estate crashed. Are you nuts? Well, it keeps getting cheaper and cheaper and cheaper and cheaper to buy it. I'll start buying them. Other people start buying them. You'll start moving, tractors, business, buy business things. They finance trucks for their business, whatever. It starts moving again, and that's exactly what they did.
Fluid situation, unintended consequences. I always hear you say, Victor. Mm-hmm. What did that cause? What did that do? When they did that rate lower, it forced you to buy stocks. It was the only place you could get. It forced everyone into the stock market.
So the stock market goes up, right?
Right.
And now you're getting the volatility that accompanies any kind of rising stock market. We just didn't have it the last few years, just went straight up. And so everything was economics. When you're doing a financial plan or you're doing your retirement stuff, you have to look at all of these different areas. The reason why we're talking about this is our industry is full of some great salesmen, but the knowledge is lacking in most of them. Ask them anything about economics, they don't know it. Now, they're going to give you every Greek letter on a mutual fund you can think of, right?
Oh, yeah.
The alpha, the beta, the Greek. Half of them don't know what it means, really. But more importantly, they don't know what it means to your portfolio. And that's what we do here. We're going to place all of this knowledge, all of this experience into everything to show you what your situation really looks like. There's no cost, no obligation. It shows you exactly, if you do this and you do this, you have a potential to run out of money at 82 years old.
And give you the options.
Don't. That's right. And the earlier you know, the better. Well, that's our show, folks. I want to thank everybody for listening to the Common Sense Investing Show. Remember, don't hesitate to call us, 972-715-2424. If you have any questions or like to take advantage of any of our programs, 972-715-2424, or you can always go to ilovemyretirement.com. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.